Our traditional finance assumes we are rational beings, always making calculated financial decisions. However, real-world scenarios paint a different picture. This is where behavioral finance steps in, acknowledging that our financial choices are often driven by emotions and psychological biases, not just cold, hard logic. We are not always rational actors, and understanding this can be the key to making better financial decisions. Behavioral finance delves into the fascinating world of how our minds work when it comes to money. It recognizes that we are susceptible to cognitive shortcuts and emotional influences that can lead to less than optimal financial outcomes. By understanding these biases, we can start to make more informed and rational decisions about our money. Our brains are hardwired to seek pleasure and avoid pain, and this instinct seeps into our financial decisions. We get a rush of excitement from potential gains and feel the sting of potential losses. This emotional roller coaster can lead to impulsive decisions driven by fear and greed, rather than careful analysis and long-term planning. Cognitive biases further complicate the picture. Overconfidence bias, for instance, can lead us to overestimate our abilities and take unnecessary risks. We believe we can time the market perfectly or pick winning stocks consistently, often leading to disappointing results. Loss aversion, another powerful bias, makes us feel the pain of a loss more acutely than the joy of an equivalent gain. This fear of loss can make us overly cautious, holding on to losing investments for too long or missing out on potentially profitable opportunities. The consequences of succumbing to these biases can be significant. Herd behavior, for example, can lead to market bubbles and crashes. When we see others investing in a particular asset, we feel compelled to follow the crowd, irrespective of the underlying fundamentals. Similarly, anchoring bias can prevent us from objectively assessing new information. We tend to fixate on the first piece of information we receive, even if it's irrelevant or outdated. This can lead us to make poor investment choices based on flawed assumptions. Confirmation bias further reinforces our existing beliefs. We tend to seek out information that confirms our preconceived notions while ignoring evidence that contradicts them. This can lead us to hold on to losing investments for too long, hoping for a turnaround that may never come. The good news is that we can mitigate the impact of these biases by adopting a more mindful and disciplined approach to investing. Firstly, acknowledging our susceptibility to emotional influences is crucial. Recognizing that we are not always rational can help us make more objective decisions. Secondly, developing a well-defined investment plan and sticking to it can help us avoid impulsive actions driven by fear or greed. Diversifying our portfolio across different asset classes can also reduce the impact of losses and mitigate the risks associated with putting all our eggs in one basket. Seeking advice from a financial advisor can provide an objective perspective and help us make informed decisions aligned with our long-term goals. Finally, educating ourselves about common behavioral biases and their potential impact on our financial decisions can empower us to make more rational choices. Understanding behavioral finance is not about eliminating emotions altogether, it's about recognizing their influence and developing strategies to manage them effectively. By acknowledging our biases and adopting a disciplined approach to investing, we can make more rational decisions and achieve our financial goals.